So, Brett, my question to you is, you've been a little quiet here the last couple of days, and I know you've already mentioned this, but I just figured we'd reiterate to anybody that missed it or not. I assume it's the headline risk that is pretty much keeping you at bay from overtrading?
Yeah, I mean, well, it's a combination of things. It depends on which way things were. But if we were coming off of a situation where I felt like we had built up genuine and serious extremes on the bullish side, then I'd be more willing to take bear setups. But when I feel like we're already seeing, a stretched put-call ratio stretched, and some of the stuff that Gavin and I are going to talk about, really big jump in, things like the Vix Term Structure, flip to backwardation, we're kind of already at that point. And I know what could happen to this market if the right type of headline hit right now. You could just see a huge squeeze. So
well, you kind of already seen it just right here. I mean, there was just like a mention of Mnuchin saying he's working on one to travel to China, and we're already getting a little bit of a pop on that.
Right. So, I mean, we're not, yeah, right. This may be something actually to fade. My hope was to actually do just that, to end up, I am having something strange going on with my Skype here. I see a ghost of an image of it. Like, I can't change other things on my screen because there's this ghost of a Skype box. It's weird. I have never seen it. Anyways, yeah. So the thing to do would be to wait for the pressure to be released off of a headline that's not significant, but that the market reacts to, and then fade that spike. And we hadn't had that until now, and perhaps this is an example of that.
Yeah, I'd like to see it play out a little bit more myself.
What about the VIX not taking out last week's highs at all? Last week was trading. Yeah, I know, not yet, right? So that's probably, that's basically a concern for me, and thinking that there still might be some further downside pressures kicking in this market. So.
Yeah, right.
All right, cool. I'll make way for you guys to get on with your flow show and your sentiment readings. So.
All right, Brett. So how are you doing today?
Doing pretty good. How about you?
I'm doing all right. Just kind of watching this action playing out like everybody else. So last we were talking, and we talked a little bit off the air, so we'll discuss this so everybody can hear. But I had made a comment to you that I felt like we were in kind of the same area to a certain extent on where we were last Monday when we were doing this, and that was we were talking, and the note was that a lot of the sentiment data that we had in our hands wasn't taking into consideration the weekend tweet, which, as we can recall last week, was the president talking about going from 10 to 25% on the tariffs. We got in on Monday for the show, and most of the readings that we had would have been from the Thursday or Friday, and therefore didn't take that into consideration. So we're a little bit hamstrung there. Now, since we talked last, we had pretty odd action in the markets last week with the early sell-off, but then that Friday rally based around comments about the talks being a little bit more constructive, that people were starting to read into things as being perhaps this was just a threat by the president. But then again, over the weekend, we had some pretty strong feedback from China, well, at least from Chinese news agencies that are viewed to be more or less the talking voice for the government out to the people. So you want to get into a little bit on what's changed over the last week since we talked?
Well, yeah, I mean, I obviously we have gone through a process that I found to be somewhat surprising, and I kind of tried to communicate that a bit in my morning notes this morning, that we actually much past, I would have believed, much past the point where I had been thinking that there was any chance of a trade deal, the market apparently still thought there was a chance of a trade deal. And so we kind of preserved some downside potential, and I suppose that this morning we're getting the full kind of process of maybe acclimating to the notion that really we're not just one more meeting away from ending the trade war with China, that it really is a situation where, and as you and I talked earlier, I mean, my feeling is this is just to give a sense of the context and where I believe the context is, because you have to understand where I believe the context is to really understand anything else that I have to say about the market. And where I see the context is really that China has identified a couple of issues that under no circumstances will it bend on. And those happen to be the same issues that the White House must get them to bend on. And so the impasse is there, and it might as well be the first day of the trade war. There's been zero progress as far as crossing over that line, and that line is the definitive line. So really, the two sides are, for all intents and purposes, infinitely far apart right now. And I felt like I knew that last Monday when we got the red line back from China, and apparently I really thought that the whole market knew that at that point. So I've been looking through last week's action through a prism of thinking, well, the market has discounted the fact that we're at essentially, a full stall impasse and likely escalation, and that this has got maybe, I even said in my notes, I think Monday morning, it looks like this trade war could have years left. And I really kind of felt that that's what the market was acclimating to. So I was looking at the market's action through that prism, and it turns out that that's not the case. Now, for anybody who's curious, China can weather the full threat. If the United States does, we might as well touch on this, if the United States does 25% tariffs on all of Chinese exports, it will represent about 1.3% of China's economy, which is easily manageable for them. So this will go there, I would say. They're not going to back down to that threat if they're looking at 10 years, 20 years, 30 years down the road. What's the long-term vision for China? So if that's where Trump wants to take us, I think that China will go along for that ride. And I had assumed that the market had acclimated itself to that. And I guess that's what today is really kind of throwing in the towel and saying, okay, this is not going to happen, and we're going to be dealing with this probably for a long time. So that really puts us now in a position, because now we've gone through that process. I think we're going through that process of price discovery in a world where we're not just a couple steps from a trade deal and ending this process with China. Now we can start to look at some shorter-term sentiment data, which we're going to get into, which basically is about the mission of trying to understand, if left to its own devices, if it's not bailed out by some kind of game-changing headline, where are we in the process of running through the panic that comes from going from one world in which we're just on the doorstep of a definitive trade deal to a world in which this is going to be with us for a long time, it's probably going to continue to escalate, and it's just a part of the fabric of reality for the markets. So this transition between that first world and that second world, it's a sentiment-based transition. There's going to be big hedges, there's going to be some panic, and we're going through that process right now. So where are we in that process? And we'll talk today about some of the sentiment data indicators that could identify kind of a roadmap of how far we've gone, because the bottom of a move like this is always made of, essentially, you can think of it like too many puts being owned. When the market is prepared for the worst can no longer happen. And so how far have we gone toward the process of being prepared for this to be, a significantly negative situation? And so we want to talk about a few of those indicators, and I think that's basically, the main thing that we can do today is identify the degree to which, if there was a positive game-changing headline, how intense would be the bounce. I think it would be pretty darn intense. But if there isn't, where really are we headed in the process of price discovery and getting to that point where people have prepared themselves for maximum downside risk?
Yeah, sorry about that. Just turn off my ringer. So one of the things that would suggest moves in that direction, Brett, would be people looking to get out of illiquid assets and into a more liquid position. And I think that's going to bring us to our first indicator here that had a pretty big move, and that would be the SPY Liquidity Premium. That was one of the items that I know you wanted to touch upon. We saw a move up on this of 8% to 27%, which certainly suggests that when people are looking to get into, you can kind of think of it along the lines of somebody moving out from growth stocks into more value or dividend names for that type of a move. But do you want to explain to people what the SPY Liquidity Premium is and what exactly we saw in that move?
Yeah, sure. So, this is what's good is a couple of episodes ago on our Sentiment and Flow show, this was one of our focus pieces where we said, let's take a look at SPY Liquidity Premium, because that will really show us some interesting things at some point, and we're starting to get to that point now. And the interesting thing that it shows is a sudden reluctance for active market participants to be involved in less liquid securities. And the easiest way to see that is the relationship between the in and out trading transaction volume in the SPY ETF versus all individual stocks. And you can look at that as a ratio. And as that ratio climbs, you can make a pretty safe inference, and it's correlated through time. It's really easy to see. This always happens when there's a market panic. The SPY Liquidity Premium spikes up, and what it is essentially the premium placed by people on the ability to get out instantly if they need to. And it's particularly active in a situation where there's headline risk, because if you're in a relatively illiquid security and there's a new, let's say, Trump tweet about, he's going to go from tariffs to embargoes and just cancel all trade relationships with China, you're not going to be able to get out of a lot of different stocks. The liquidity will disappear. You're going to be trapped in it if you have like a sudden limit down crash in the market. But SPY is so liquid that you can turn on a dime and get right back out.
I thought one of the more interesting things from the spread was just a week ago when we were talking about this. This was at near the excessive optimism side, and then it's flipped within a few days over to the excessive pessimism side,
which is the signature hallmark of a headline-driven fall in the market. Something suddenly happens, and everything about the way that people are behaving changes instantly, and it's based on that thing that happened.
Yeah, just so people are aware, the last time we saw these moves would have been mid-December. Then the last time we saw a big spike would have been right around that first weekend of October, which, if we recall, led to really the whole decline going down. And then the other time would have been February of 2018, which would have been right around when these trade headlines really started to kind of pick up steam and impact market psyche.
That, and I think the unraveling of the short VIX bubble.
Yeah.
And the fact that people had gotten into essentially a sort of pyramid scheme about a misunderstood understanding of funds that are related to the VIX. But yeah, I consider that in February of 2018 to really be a mechanical crash in the market. And I think that people don't know what's happening, and they rush to whatever's the most liquid way to participate. And you saw that spike. I think that is starting to show we're above a threshold where, at any moment, if you get the right type of headline, you'll start to see a change in psychology back the other way. So that one is close to saying we're close to some sort of bottom. But again, since this is such a headline-driven tape, and one of the things that Scott asked me about right off the bat today, and the impact that has for my strategy, you can't count on that, and you don't know what happens in the absence of that. But as far as going through the process of, are people kind of panicking right now, yeah, people are kind of panicking right now, and it's starting to show thresholds that are consistent with, at this point, this is a sort of minor degree panic. It's not blossomed into a major degree panic. If it doubles from here, which is, as we talked offline, if there's not anything that saves this situation and there's continued kind of real tough talk rhetoric, then there is a bloom on this flower stem that can still happen. There's a significant further degree of panic that can happen in a market than we're seeing right now.
Yeah,
so we have not gone to a point.
Even all the selling's been relatively relatively orderly.
Yeah, so I think and that's really what we're trying to do here with the show today is this is not all out crazy panic. This is skepticism and the awareness. This is wariness right now. But since there's not, if you believe that there is not a quick and simple solution to this situation, then a lot of other things kind of have to be reorganized around what the outlook is for this relationship. But at the same time, you had 3.2% GDP in the first quarter and a Fed that is now almost back pricing in a rate cut in September with decent earnings growth. And at some point, those sorts of ideas are there in the background in this market. So I don't know how easily we will get to all-out panic in that sort of situation, but I think that we'd have to have some further escalation in terms of how this relationship and this drama around the trade war proceeds. I don't think you can just have everybody silent and the market escalates into complete panic at this point. So, but certainly if you see SPY Liquidity Premium double from here, and you don't really see another catalyst, then I think that you're dealing with a situation where you've got a pretty steep bounce ahead.
Another area that we've seen go from on the cusp of excessive optimism, all of a sudden slipping down to that excessive pessimism, would be the Inverse ETF Volume. And you want to explain why that's such an important read, Brett?
Yeah, sure. It's pretty commonsensical here, but when you see a sudden focus and people get really excited about trading inverse ETFs in the market, and you see, the volume in those things triple over the course of a week, you know what sort of market you're in. And we've gotten back to the types of thresholds that, again, commonly kind of mark, market panics. But again, it's in a situation where, if we see this double, then really come get me, and I want to buy. It's not crazy, but it is to the threshold where you have a significant position in the market, leaning really hard, looking for things to get worse, and you have a significant amount of people. And another way to look at this particular instrument is probably a significant amount of people who have long side portfolio positions that are entrenched positions with a cyclical or long-term or even structural outlook, where they are flattening out their leveraged exposure to the market by purchasing inverse ETFs. So it's a hedge in a very traditional sense. And when people who need to be long and who plan to be long get overly hedged, the result of unhedging is the exact same thing as a short squeeze, because it's around a baseline expectation of exposure. So you're piling up the ability to squeeze, but you haven't piled it up to anywhere near where we were, for instance, in the middle of December. So we've got further to go there as well if conditions would continue to play out. You don't need to avoid shorting this market at this point. Or if you're like Gavin, who held his short and stayed with it very nicely, Gavin's sitting short the S&P futures right now, you don't need to cover. There's nothing saying this is it, the flower has bloomed. He's got exposure risk to headlines, but it hasn't fully manifested the downside potential.
Yeah, I feel the worst case scenario for my short, well, not the worst case scenario, but Friday we got a pretty fair idea, I think, of what you're talking about, Brett, in terms of the potential for a whip around headline really giving us the move. But again, I think both of us were in agreement that we just felt the market got Friday's constructive talk headline wrong here.
Unbelievable. So. Yeah, and again, it's that interpretive issue of like, is this the case that, and here was my error there, is this the case that the market gets it and is just, really, looking past it? Or is it the case that the market is fundamentally misinterpreting something? And I feel like I usually don't like to take that step. I usually like to give the whole sum total of market decision makers the credit for being a reasonably good discounting information processing machine. And that, I'm not going to sit here and understand the headlines better than the sum total of money that's moving in and out of the market. But that was an example where I have to say, at this point, I'm sitting here thinking that the market just didn't realize what was happening. And it just took going through the weekend and thinking about it, and now suddenly it's very clear that this was an irresolvable dilemma, at least over the near term.
Okay. I know Robo and Lobo are two ratios that you follow pretty closely. Was there anything sticking out to the moves there that
well, first, do you want to notice President Trump just came out, so there's a thing hitting.
Okay, let's take a quick look at the headlines. Carmine had noted that he had planned to talk. So President Trump, some of the headlines that we're seeing there, expects China to try to retaliate versus U.S. farmers, saying that they will protect the farmers. Says China wants to have a deal. Continues with that China's backtracking on trade talks, which he said was unacceptable. So I've not seen anything. He says he has not made a decision to go ahead with tariffs on another of the $325 billion in goods from China. It's technically $304 billion. So I'm not seeing any changes there in the temperament from the president, saying you can't let China take advantage of us.
No, right. Now, I think that saying that he's pledging, I see $15 billion that he's going to take from tariff revenues and use it as aid for farmers.
Yeah.
But it's not, there's not actually $15 billion that's coming in from China, right? I mean, it's U.S. companies are paying that if they choose to continue to import stuff from China. So he's just taking it from U.S. companies and giving it to U.S. farmers.
Maybe this is what's getting people excited, and this is another topic that we'll discuss shortly, Brett, but saying U.S.-China meeting at G20 could be fruitful. So we're already seeing
it's constructive, it's fruitful, etc.
Similar to what we saw in Argentina, and we'll get into that here in a little bit, because I did have a question for you on that I wanted to ask you on air.
Sure.
It seems to me the robots are buying on this. We were already getting a little bit of a boost from Mnuchin here, but like you said, I'd love to see it get back up to that 28.30 level, in which case I'd be interested in jumping in and adding to the short here.
Yeah, right. I mean, that seems, I don't see anything that necessarily changes the game. And we do have this bet. What we're just talking about with the inverse ETF volume and some of the other things that we're going to get into suggests that the market is something that can provide opportunities by meaningless headline slight squeezes. That there's too much lean, but not so much that we've really found a serious bottom in the absence of new catalysts. And so if it's not a materially game-changing kind of headline, you're going to shake some of the shorts out, and it offers an opportunity to reshort.
Yeah, I mean, for me, it just seems to kind of continue to press home that the upward trend remains the primary one, and that the reflexive muscle action for the markets remains to buy dips here. And just seems like there's
or cover. I mean, there's a lot of
or cover shorts.
Yeah.
No, that's definitely fair. And with that in mind, I guess it's a good time to go back to that Lobo and Robo put call ratio. Brett, was there anything sticking out? I know they're kind of in neutral territory right now. And anything in the moves that you thought was a little odd, or is this pretty much in line with what we would expect given the market action last week?
Okay, so they Robo got to where it signaled a potential for a near-term short as of a couple weeks ago, right? It barely poked into that, and it's one of the reasons why we took the short off the Fed. It suggested there was a little bit too much lean, a little bit too much of a mentality during the thick of earnings season where you just load up on calls because they're going to beat the number because expectations were too low, and this market doesn't have any other big headline risks because the China situation is about to be resolved. This is 2 weeks ago. This is the world as it was then. So at that point, we had signaled a slight extreme in too much optimism among small account holders, non-professionals in the options market. So we had that in place. And the effect of what we have seen over the last 10 days and the drama that's played out since China returned the red line and the escalation of tariffs, we've seen it move back to basically the middle. And I'm guessing this data is posted on Saturday, so I'm guessing we're evolving into a situation where we haven't gotten there yet, but we're heading toward a situation where you don't see non-professional traders are buying no calls. At some point, we're going to get there. I think if this kind of continues to play out roughly in this manner, and then that would be another factor on a slightly larger and more significant time frame of signaling a buying opportunity in the market that's being forced into place by this headline drama. But we have not gotten there according to that.
Okay. Let me ask you, any of the other sentiment readers jumping out to you from Sentiment Trader here?
We're left in the same situation as we were last week as far as anything larger time frame. The other one that I would look at is the Vix Term Structure. So this gets to a situation where this is essentially the map of the relationship between the pricing of short-term contracts on the VIX futures market and longer-term contracts in the VIX futures market. And it's essentially the statement so we talked about this one I think a few weeks ago as well. But here's the idea. The idea is the typical base case reality. Just in a philosophical sense, the further future is more uncertain than the near future. And if you think about anything, like what's going to happen tomorrow, look at a meteorologist and the weather. Like everything gets less certain the further out you go. There's a greater accumulation of variables with a greater accumulation of disparity in outcomes. So obviously, the further future is less certain than the near future. However, in certain strange circumstances, and in that normal circumstance, there's a contango to the VIX futures curve. In other words, VIX futures contracts are more expensive the further out you go because there's more uncertainty the further out you go. So under strange circumstances, when there's an event-driven kind of crazy panic, or when markets are behaving in a mechanical panic, like we saw last February, you get a situation where you shift from contango to backwardation in that curve. And that means that the near-term VIX futures contracts suddenly become more expensive than the further out VIX futures contracts. In other words, saying that next week is less certain than 3 months from now. And it's peculiarly given to that situation, I would say, because, especially last week, we don't know how the next headline is going to hit and where this is going with China. However, we do kind of know that the Fed is pretty dovish right now and may do a rate cut and the economy is not doing that bad. So there's kind of a sense of I feel more confident understanding basically where the market might be poised, 3 or 4 months from now than I do 2 weeks from now. And that kind of situation, when that gets stretched, when the inversion there, the backwardation between those relationships gets extreme, it points to something similar to like the Inverse ETF Volume or the SPY Liquidity Premium. They're shorter term, kind of everyday posted indicators of the sort of diagnostic temperature situation for panic. And you get a panic going, you're going to get some big extremes in that. We're just the same place we were with the other two. So I got to say, it's like a minor degree panic right now. It is not a crazy panic. Nothing like December. It is nothing like last February. It is pricing about like, well, it's nowhere near where we were in August 2015. It's just kind of, it's like a pullback that gets a little bit emotional. We're not seeing that kind of, if you're looking to buy into something when everybody's just crazy, throwing stuff overboard for nothing, it did not get there. We have not reached that point. We would need another kind of intensification of this pullback to get there. But it is at a point where people are leaning in that backwardation. It at least triggered the backwardation as of Friday, I think.
All right, and with that in mind, Brett, then, I mean, for you, in order for it to get out of this current situation, I'm thinking that you really need to get the idea that, okay, maybe a deal isn't in place. Because right now it seems to me, given the past action over the last 18 months, I would say, dating back to January 2018, I feel like the market's always been in the mindset that neither one of these leaders want to go down the road of no deal and seeing things fall apart. They don't want to take the pain. But it's kind of pushing that the idea that there would not be a trade deal is probably the breaking point for this. Would you agree with that?
I mean, it seems to me, but, I don't know how that we're not psychologically already kind of there. I mean, even though, there always can be a deal someday, but the idea is a deal something that is going to be pricing into, Q3 and Q4 earnings, are we, and guidance, or is this something that, we're going to be talking about this G20 in the winter and G20 next summer? Are we headed in that direction? And I wouldn't understand how we aren't already starting to acclimate to that reality. But I think that it could be more technical than just about understanding more information about the deal, because there is also the point where, just based on risk appetite, at a certain point, people are hedging, people are down, people are feeling unhappy about what the market is doing. Even if people feel like the future will be better someday, you can get to the point where you just can't take it anymore and you puke. And especially if there's significant leverage, and you never know where that leverage is. You never know who's holding that type of situation, who's gotten really, piled up on. I know we saw a really big position short the VIX futures market again, coming ahead of this whole thing, and now we're seeing a VIX that's steadily above, its long-term average, and that sort of thing could kind of spike the VIX up disproportionately and kind of scare people, and maybe we break through a significant level. One of the possibilities is we break through 2,800 and we really start to puke our guts out, and it's really more sort of technical, and based on crossing a threshold given where leverage is positioned in the market. So it's tough to say. I mean, obviously, throwing in the towel on the idea that there's going to be a trade deal anytime in the next few months is a good way to spark that. But I think it probably is more about getting to kind of, pain thresholds in the tape.
So with this G20, obviously, it's going to start getting on a lot of radars. I find right now the market's to be pretty reminiscent of what we were seeing in the late fall and October, when we started, we're breaking our earnings season. People were starting to factor in the idea that there wouldn't be the tax boost and there'd be a little bit weaker round of earnings in 2019 in general. But the trade remained in the backdrop. Neither side was really talking at that point, and there was definitely some concerns. But we had that Argentina G20 meeting that people kept kind of earmarking as the hopeful save-the-day moment. We chopped around a lot in that period leading up to the Argentina meeting, and then it was once Argentina kind of passed and we started getting into December that we really started seeing some of the selling pressure. Do you see any parallels coming up to this G20 meeting at the end of June and the potential for the markets to react in the same way leading up to that, or do you think we're in a completely different environment from there?
So I would think that we are in a completely different environment, but it would be plausible for me to feel the same way about that statement as I felt about my interpretation of things last week. That I would think that it's no longer plausible. Actually, I'm going to short the NQs here. Just let everybody know.
Okay.
I'm putting that out. I mean, it's half size. It's 20 points of risk. If we move back up to that high, I'll let it go. But I feel like I need to be
exposed.
in this Yeah, right. So we'll see. Maybe we'll manage to push it up there. But I feel like there's just I see that just running into this offer here after that headline. It just feels like there's a lot of hope that's just come in that's vulnerable to get kicked right back out. So we'll see.
That's how I see this too. So I'd like
But, I mean, I'm going up against the indicators that we were just talking about. So there is a lean already to this market, and I understand that risk is there. So anybody who's playing along, understand this could easily spike up through my stop. It's just I feel like the risk-reward here is strong for a move down through the afternoon lows. We've already kind of cleared out some of that lean with these headlines, so it makes it a little bit safer. So what was the topic?
We're discussing the parallels between what we're seeing right now in the markets and what we were seeing back in October as we come into another G20 meeting.
Right. So I feel like the plausibility of the idea of whatever is, I mean, there's going to be PR around it, no doubt about it. There's going to be another trying to building things to a head from each side and hoping that the other side will come a little more toward them, and trying to generate a sense of optimism about the situation and that there's competent drivers at the wheel of the situation. So I think that that's all going to happen, and then how the whatever result is there is going to be messaged and spun in a way that's to attempt to show all of those things are true as well. There's hope for the future. There's competent people at the wheel. We're in the midst of an important negotiation, et cetera, et cetera. But I think that the beautiful thing about what we saw last time around, and was one of my biggest shorts of the year, was, we got a huge gap up into it and just kind of unleashed a campaign of a series of shorts for me that were really highly productive because we had people really buy into the idea that this was easy to solve and that the messaging was straightforward. And I think that enough people would have gotten burned by that situation. It really depends on where the memory of this market is, because people really were willing to trust the idea that there was a kind of standard process in place that would go ahead and feed through, and that there wasn't a lot of misdirection in terms of the way things were being communicated on each side. And lo and behold, we found out that there was a lot of that, and that it really wasn't a straightforward job of it was a show. They put on a show at G20. They put on a show of saying, we basically got, as I recall, it was kind of like, hey, we basically got a deal. We just need to iron out a few details. And so we're going to give ourselves a 90-day window to make sure we get that together. But we had a great talk, and everybody's on the same side that we definitely need to get this done, and et cetera, et cetera, et cetera. And it turns out that, really, again, as we said earlier here, there's a set of sticking points that really are kind of the whole point. And if China's, no matter what, unwilling to relent about those things, and if the White House is, no matter what, unwilling to relent the other side of that, and we've really made no progress on kind of resolving that difference, then there, again, it's like we're back at square one. And I wonder how much, it's a boy who cried wolf situation. I don't know if the messaging can achieve the same degree of faith by market participants. So I think if they're different, it's different in that respect.
Sub wrote in a good point too, Brett, where monetary policy missteps were a lot more prevalent.
Yes.
In that
and now the Fed has pivoted. So so there's a cushion there. But as far as just putting, so I'm interpreting it as, hey, that was a great trading opportunity because the market got put off sides in a way that made it, very obvious. A couple days later, I felt that there was a kind of, there was a lean that could be taken advantage of in the other direction. And yes, absolutely, monetary policy had a big part of that because the Fed was kind of trying to. It was a freshman Powell, and he was making those freshman errors. He was saying, you know what, I'm going to be different than the other guys were at the Fed. I'm just going to focus on the economics and let the markets take care of themselves, and I'm going to make sure the market knows that. And that was
the market told him what was up.
Market. We found out who was in charge, and
it was not Mr. Powell.
Your ideals are wonderful, but.
So, all right, Brett. Well, I'll tell you what. You got anything else to add? So, I mean, I think both of us are in the mindset that we'd rather be shorting pops here. Obviously, it's going to be a minefield, and we are wary that a turn in sentiment to a more positive side could certainly still be in the cards here. So I think neither one of us would be looking to be too aggressive on the short side.
Exactly right. So small size. I would say, I normally say small and wide. I say small and tight here because I think that when you get a post pop, just like we just saw, so we got a headline, you could see the bars on that chart. You could see the aggressive pop. We got the roughly like the 2 p.m. Eastern highs that came in, melted down a little bit off it, got a new set of headlines, spiked up through it, took out those stops, cleaned things out. So you see the shift in volume, you see the pop above that, looking at the S&P or the NQs. You know that we've gotten to a point where now if we start to move down past that, you're not going to see another headline right now probably. It gives you a little window to start to try to get something productive going on the short side. And you can have a tight stop because if it's able to eat up through that, then the market is starting to read more into this. And you get to sort of a higher degree version of shaking things out where you could see that pop triple. You know, kind of like we saw Friday into the close where we didn't really have that much to work with, but we started to cascade out and we started to get shorts under the gun. And then people just, you know, the bots and momentum got it going, and we just cleaned out all the short interest pretty much across the market. For anybody who's, you know, day trading or short-term minded or, you know, actively participating on the short side, everybody just got cleaned out in a cascade. So you can get that going. But here, we've knocked it down. You can see whether or not it's going to be defended on that short side, and we're going to try to break it down through the 2,800 level. And I chose to go with the NQs on the short, but I think it's a good example of that type of setup that can work. And, you know, again, if you're small and you're tight, then your worst-case scenario is extraordinarily manageable. But in a market with the VIX widening out the way that it is, if you're right, you know, you can get – this is the type of market where you can get that sort of quick 100 points in the NASDAQ. You know, you can get that kind of escalation, and the ranges are stretched out enough now where you can do a 5-to-1 risk-reward on a relatively small-size risk that ends up turning into something that's really, you know, really potent. And yet, you know, at the same time, if it doesn't go right, it's really just a tiny ding. So I think that those sorts of opportunities, and especially coming after a headline and after you see a resumption of resistance, that's the time to kind of try it, see if you're going to get that new round of lows following the headline. That's the kind of traditional cadence of a bearish trend that hasn't yet bloomed that flower. We're not seeing these extremely aggressive spikes. We're not seeing, for instance, I've got put call right now under 110. That's not an extreme. You're not seeing that kind of, you're not seeing it at 160. I would never take this trade if it was at 160. So it's just kind of, you know, it's that situation where you're partway through something. You're always vulnerable to the headlines. A new headline could definitely hit right now. I think that one of the important points is to realize that's one of the other things that made me hesitant earlier is, and constantly hesitant, is that the White House knows that their negotiating position is hurt by downside movement in the market. You know, you have...
So it's going to be that White House put.
There's an incentive to try and bail the tape out at any given moment because your conversations with the Chinese are going to be emboldened to continue to take a tough stance because they're going to feel like if they just keep the pressure on, you know, eventually Trump's going to have to give in because, you know, there's too much coming at him in terms of things falling apart. So there's an incentive there.
He's tied this market to his presidency, of course.
He's tied to his presidency, but just in general, you know, people start hurting. People start feeling like, or at least it's just a perception problem. There's something going wrong if the market's going down. And if China has the ability to make everybody feel like there's something going wrong, then it gives them leverage. And so the White House certainly doesn't want them to feel that way. So there's that makes it all the tougher, but yet the trend is down, and we have not reached, you know, clear patent extremes.
Yeah, so, well, on this trade, Brett, what would be some of your inside targets here? 73, 40, and 20, basically, for the inside, and then we get through there.
73, 35 on the inside, and then, break of the lows. They're starting to battle back here, so we'll see.
Yeah, so you're going to get that roll over there, but they're obviously putting on a fight, and that would be anybody that just jumped in long on those headlines, I feel. But I agree with you. I think they're on the wrong side of the trade. We'll see how much of a fight they got in them here, though.
And there's always the possibility there's something else going on that we're about to hear about.
True. Very true. President Trump isn't scheduled for any other talks this 2 p.m. Piece was Carmine had given us the heads up on this earlier, so that wasn't a surprise. And we do have Mnuchin later on in the week too. He's going to be testifying about the budget, but you can be sure the trade talks will be on there. That's still a couple of days away though, but something to keep on your calendar there. Carmine had posted the follow-up to our conversation on some of the different headlines that we could be on the lookout for. So highly recommend checking that out. Brett, anything else to add here at this point then?
No, I don't think so. I think we just keep it, right around this tightly
Simple,
defined
yeah.
set of points. Yeah.
Yeah, exactly. Because obviously we could get out. One thing I will throw out at you before we part ways, though, Empire Manufacturing's out later this week. Philly Fed. There is also a few German. I think the GfK consumer surveys out the ZOO survey for Germany and Europe. How much of them are you paying attention to in order to factoring into some of your decisions here, or not at all?
Not a lot. I mean, I think that we've got this continuing kind of drama around where the Fed is in relationship to what's going on with the China situation, where we've seen the Fed funds futures clearly moving in response to this breakdown, kind of getting close to saying that there's a cutback on the table for September, despite the continued language from the Fed that's saying, no, we're just staying where we are. So I think that's interesting, and that impacts the euro, and if we start to see stronger than expected data out of Germany, for example, we're clearly going to see an even greater push to possibly start to do one of the things that's imbalanced in this market, which is start to clean out the rampant short interest sitting in the euro.
Yeah. So, all right. Well, there you have it. Well, Brett, as per usual, thanks for joining us here. And look forward to talking to you over the course of the week and certainly next week, too.
You got it. Thanks again.
All right.